You are 19, and the woman behind the counter is deciding whether you deserve a checking account. She is not unkind about it. She just has a form, and the form has boxes. And one of those boxes is asking whether Silas Cormac Reyes, with no credit history, no employer letter yet, and part-time hours at a hardware store, is someone a bank wants to hold money for. Banks call this tier retail banking. And at this tier, you are not a relationship. You are a risk score the software has not calculated yet, because there is not enough data to calculate it from. You answer her questions like you are at the DMV. Yes, that is my current address. No, I do not have a cosigner. She types. She waits for something on her screen to turn green. It turns green. You get a debit card with your name spelled slightly wrong, and you walk out feeling like you got away with something. At the retail tier, the bank sets every term, and you accept it or you do not get an account. There is no negotiation over the $11 overdraft fee, no discussion about why the minimum balance requirement is what it is. You learn this directly at 20, when a $34 coffee purchase pushes your balance below zero and triggers a fee nearly as large as the coffee. You call to dispute it. The representative explains, correctly and without much sympathy, that you agreed to these terms when you opened the account, in paperwork you signed without reading closely at 19. You pay it. This is what it means to need the bank more than the bank needs you. The terms are fixed, and you are the one adjusting your behavior to fit them. That imbalance is almost invisible when you are young. You simply assume that this is how banking works. Nobody at the bank explains that the first tier ends, or exactly when it ends, and the years between it and the second tier pass without any obvious marker. At 22, a pre-approved credit card offer arrives in the mail, promising an exclusive rate, and Silas comes within 2 clicks of applying before actually reading the fine print. An interest rate high enough that the word exclusive is doing a lot of marketing work to disguise it. He throws the offer away, mostly because Patricia's underwriting process, still a year off, has not taught him anything yet. The instinct that stops him is smaller than that. A habit, picked up from paying too much attention to his own statements, of reading the terms before agreeing to them. It is a minor moment. It is also, in retrospect, the first behavior the second tier's algorithms will eventually reward him for. Nothing dramatic happens between tiers. The shift happens quietly, one financial decision at a time. 4 years later, you are sitting across from a loan officer named Patricia, applying for $11,000 to replace a truck whose transmission gave out on the interstate, and the relationship has changed shape without changing power. Patricia is not deciding whether you deserve to exist as a customer anymore. She is running an underwriting process, and underwriting has specific inputs that most people never learn the names of until they are sitting across from someone like Patricia. She pulls your debt-to-income ratio, how much of your monthly income already goes to existing debt payments, expressed as a percentage, with most lenders wanting to see it below somewhere around 43%, before they will extend much more. She checks your payment history, 18 months of a checking account that has never gone negative since the coffee incident, which reads to her software as a stability signal. She calculates the loan-to-value ratio on the truck itself, since the vehicle serves as collateral, meaning if you stop paying, the bank has a specific, repossessible asset behind the debt, rather than just your promise. None of this makes you powerful. It makes you legible. A file the bank can price risk against instead of a stranger it has to guess about. You signed 40 pages you do not fully read at a rate that reflects exactly how much risk Patricia's software calculated you represent. No more favorable and no less. The difference is subtle but important. The bank still has the leverage, but now you have something it can measure. What Patricia's process does not reveal because it is not designed to, is how thin the margin for error actually is at this tier. 2 years after the truck loan, Silas is late on a credit card payment by 4 days, during a month when a client of his employer paid invoices slowly and his own paycheck arrived later than usual. The late payment does not just cost a fee. It shows up on his credit report and stays there for years, quietly raising the rate he is offered on every subsequent application. A consequence that is disproportionate to how minor the actual event felt at the time. The second tier rewards consistency far more than it punishes any single mistake severely, but it does register every mistake, permanently. In a file Silas does not get to see updating in real time the way Patricia does. At this level, financial power is not about having money. It is about having a record the system trusts. 7 years after the truck, a private banker named Preston calls you, unprompted, and the call itself is the tell that something has shifted. Retail banks do not call people to invite them to coffee. But once a customer's combined balances across checking, savings, and a small brokerage account cross a threshold most institutions set somewhere in the low hundreds of thousands, an internal flag gets triggered, and a person like Preston gets assigned to make sure you do not take that balance to a competitor. The industry calls this segment mass-affluent, and it is a genuine tier with its own name, its own dedicated staff, and its own set of products, slightly better rates, waived fees, and a phone number that reaches a human instead of a menu. Preston is not evaluating whether to let you in. He is managing retention. The disorientation of this tier is that it feels like flattery, and it partly is, but it is flattery with an economic motive behind it. The cost of acquiring a new mass-affluent customer is high enough that keeping an existing one happy is, for the bank, simply cheaper. For the first time, the bank has a reason to make your experience better. The uncomfortable part of the third tier, which nobody markets honestly, is that Preston's attentiveness has a specific expiration condition built into it. His compensation, Silas learns much later from a friend who works at a different bank, is tied partly to how many mass-affluent relationships he retains and grows each quarter, meaning the coffee, the birthday card the bank sends, and the slightly too personal interest in Silas's career are a retention strategy with a dollar figure attached on Preston's side of the desk. That does not make the relationship fake, exactly. It makes it transactional, in a way that is easy to mistake for friendship if you are experiencing genuine bank attention for the first time in your adult life. The attention is real, so is the incentive behind it. At 34, something happens that would have been unthinkable to the 19-year-old with a misspelled debit card. You do not just take a business line of credit at whatever rate the first bank quotes you. You negotiate. You take the term sheet to 2 other banks and let them compete for it. One waives the origination fee entirely to win the relationship. Another shaves a quarter point off the interest rate because losing your deposits to a competitor would cost them more than the discount does. This is the fourth tier, and its actual mechanism is leverage. Once your deposits and your borrowing needs are large enough to matter to more than one institution, you stop being a price taker and become a price setter, at least at the margins. You walk away from the second bank's counteroffer entirely at one point, calmly, because you no longer need any single lender badly enough to accept unfavorable terms. That single behavior, the willingness to walk, is worth more than anything in the 40 pages of paperwork ever was. You are no longer asking what the bank will give you. You are asking which bank wants your business badly enough to compete for it. That is the moment the relationship truly changes.
To understand where this ladder eventually leads, it helps to look at the one moment in American financial history when a single private individual reached its absolute top. In October 1907, the New York Stock Exchange lost nearly half its value in a matter of weeks after a failed attempt to corner the copper market triggered a chain reaction of fear. Depositors, worried their banks might not survive, lined up to withdraw everything, which is exactly the behavior that makes a bank stop being able to survive. Trust companies collapsed. Cities could not meet payroll. There was no central bank yet, no Federal Reserve, no institutional backstop built into the system. When the panic peaked, the country turned not to its government, which lacked the tools, but to a 70-year-old financier named John Pierpont Morgan. Morgan summoned the heads of New York's major banks and trust companies to his private library on Madison Avenue, had them lay out their books in front of him, and, when they could not agree on which weak institutions to save, locked the doors himself and kept the key until they reached a deal, sometime after 4 in the morning. Over the following weeks, he personally directed capital from stronger banks toward failing ones, backstopped the New York Stock Exchange with his own resources, and helped keep New York City itself solvent. One man, using his own judgment and his own balance sheet, did what the entire financial system could not yet do for itself.
Congress was so unsettled by how much power had concentrated in one private citizen's hands that the panic directly contributed to the creation of the Federal Reserve 6 years later. Specifically, so the country would never again have to depend on one financier's goodwill. The following year, lawmakers passed the Aldrich-Vreeland Act, an emergency measure designed to give banks more flexibility during future panics, named for Senator Nelson Aldrich, who then spent several years working in secrecy with a small group of bankers on Jekyll Island, drafting what would become the Federal Reserve Act of 1913. The fifth tier, taken to its historical extreme, did not just reward the man who reached it. It frightened the nation into building an entire institution to make sure nobody would have to reach it again. You are never going to be J.P. Morgan. Almost no one ever will be. But the ordinary, modern-sized version of what he represented still exists inside the banking system today, and it has a name. At 41, a regional bank you have never done business with calls your office, not to sell you anything, but to ask whether you would anchor a small private lending facility they are structuring for local commercial borrowers. A restaurant expansion, a physical therapy clinic opening a second location, a landscaping company financing its first fleet of trucks. Banks need committed capital to make facilities like this viable, and your name surfaced because your deposit history across 2 institutions shows large, stable balances that rarely move during a panic. The exact behavior the 1907 crisis proved a banking system cannot function without. You are not asking the bank for anything. The bank is asking you to be part of the reason the system can extend credit to people who are not you. 2 years into the arrangement, a regional slowdown puts 3 of the backed businesses behind on payments in the same quarter, and the bank calls a meeting of its anchor investors, not to punish anyone for the losses, but to ask whether you will support extending patient terms instead of forcing collections. You vote yes. 18 months later, all 3 recover. It is the clearest proof you get that this tier is not a status awarded once. It is tested occasionally, and it holds because the underlying behavior, steady, unpanicked, patient, never changed from the tier below it. At this level, the bank is no longer simply managing your risk. It is relying on your capacity to absorb risk. Five tiers: retail customer, underwritten borrower, mass affluent client, negotiated relationship, liquidity provider. Almost everyone starts at the first tier, and most people, through no fault of their own, never learn there are 4 more above it, because no bank sends a letter explaining the ladder. That is not in its interest to advertise.
You find out only by living inside the system long enough to notice its rules quietly changing shape around you. The same underlying behavior read completely differently depending on which side of the desk it is evaluated from. The money changes, the leverage changes, but the deeper shift is who needs whom. And somewhere back in October 1907, in a library on Madison Avenue, with the doors locked and the key in his pocket, one man proved exactly how far up that ladder a single person's judgment and balance sheet can climb when an entire country runs out of other options.